Everybody, happy Thursday. We have quite the week of market moving things here this week. The yield curve officially inverted this week. And so the entire talk and the question we're going to spend a lot of time on is, what does this mean this time? My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a little bit of the noise that we all deal with day to day. So this week is noise, but it's important noise, and I think something I wanted to make sure to talk about. I think it was Tuesday, that the yield curve officially inverted. So the 2-year, what that means is that the 2-year the interest rate you would receive on a 2-year bond was officially higher than the interest rate you would receive on a 10-year bond. Now, let me start by saying this happened for, I think, about 20 minutes. So this isn't something that's been a long-standing thing, but it did happen. And the entire financial news is talking about this phenomenon. So the reason it's so important is because essentially what that means is that things are backwards, things are screwy, right? If you're willing to loan more money for 2 years, loan money for more interest for 2 years than 10 years, something's a little off, right? Generally speaking, if you are loaning somebody money for 2 years, knowing you're going to get your money back in just a short period of time, what you get for that is a lower interest rate, right? You're not going to get as much money. Versus if you're loaning somebody money for 10 years, you might get a higher interest rate because they're going to have your money for a longer period of time, right? So the reason that this is so backwards is because what it typically signals is a concern over the short term and stability in the long term, essentially, right? The reason that I wanted to talk about this is because, generally speaking, when the yield curve inverts, bear with me a little bit, but I think it's 12 to 18 months, somewhere within that period, we typically see a recession. Now, I'll share why I don't think this is a clear signal for that this go around, but it's very, very important to talk about. In fact, even if we look back in 2019 was the last time the yield curve inverted. And guess what happened in 2020, right? We saw the recession due to COVID. Now, that's where I want to start really breaking this apart a little bit here. Please keep in mind, over the last 4 years or so, the Fed has been extremely pivotal. They have been very hands-on in the interest rate market, especially. And so one thing I want to touch on is back in 2019, when this happened, yeah, we moved into a recession in March or April or so of 2020. But remember that this had nothing to do with interest rates or, the impacts of interest rates to the markets. This was entirely a COVID-driven recession. Okay. So first off, I want to make sure that that's very clear, that although it technically was true last time this happened in 2019, the events that came after that were completely separate, right? The events that caused that recession. Now, here we are in 2022, March of 2022, and it's happened again. Now, the thing that I want to share this go around is, again, really tied to the Fed. Okay, the Fed has been trying to control markets for the last 5 years or so very aggressively. They've basically kept their foot on the lid here of interest rates, and for what a lot of people, myself included, think maybe too long, right? So keep that in mind, that we had this artificial ceiling, so to speak, on interest rates. And I personally believe that that's a big reason why we're seeing this inverted yield curve today, is because we didn't let the markets do what the markets do, right? If that were not there, obviously this is hypothetical, but it's possible that interest rates would have moved sooner. They would have moved more based on market reactions and not artificially kept the short-term rate down because the Fed was doing that, or kept the long-term rate down tied to the short-term because of that, but also because they were buying a ton of assets on that longer-term scale. So keep that in mind, right? Those ceilings have been in place, but not due to any sort of market-driven reality. It was all based on restrictions put on by Fed keeping rates low and buying assets, if that makes sense. So that's a lot on this inverted yield curve, but I do think it's really important. And the reason I wanted to share that is because from my perspective, I don't believe that just because the yield curve has inverted that we are due for a recession. Now, that said, there are plenty of other things going on that are a little bit concerning. So we're watching those very, very closely. And if they become reality, obviously we'll make sure to talk about that here in our weekly updates. But the fact of this 2 and 10-year interest rate switching, going, the 2 being higher than the 10 for 20 minutes, in and of itself does not, to me, lead me to believe that we're due for a recession. And again, not because of the phenomenon of it, but more because of the way we've gotten here, right? It's been because of kind of this artificial market that we've had over the past couple of years. So obviously it's something to keep a very close eye on. And in fact, 2s and 5s and some of the other areas of the yield curve were inverted, I think, on Monday as well. But the 2-year and the 10-year bonds are ones that people pay very close attention to. And that did officially invert. Again, I believe it was Tuesday or Wednesday. So it's definitely something to watch. But again, I do not think that this in and of itself is a reason to, be concerned about a recession on the horizon. Again, I will add to that again, there are some other things to keep an eye on for sure. But just this in and of itself is what I'm really referring to. Okay. On top of that, this week is jobs week. So just yesterday on Wednesday, ADP employment report came out and 455,000 jobs were added according to this report in March. So that was a good number. Hopefully on Friday, we'll see an even better number for non-farms payrolls. But there's a lot of chat, a lot of concerns right now about signs of slowing consumer confidence and possibly signs of a slowing job growth or job market now. So this will be really important to watch. And although this month may start to tip the cards a little bit on where that's going, really as we move into April will be extremely important to watch these jobs numbers and the consumer confidence. Because, if there are some concerns that can leak through to the market as well. So definitely something to keep a close eye on. So coming up next week, we're going to skip our question of the week here this week because we are gearing up for our financial challenge starting on Friday. So we will be back next week. I promise we'll have a question of the week then. But this week, we got a lot of gearing up to do for Friday. But as we jump into next week, of course, we'll be back on the question of the week. And then we will also break down all this jobs data that we'll get. We'll break down the non-farm payrolls. We have inflation numbers coming out, and then the Fed minutes come out on Wednesday as well. So that will be very important to watch as we move towards, I think their next meeting is May, but there's a lot of conversation about them potentially raising rates by 50 basis points this time. I don't know that I feel it will be very likely at this stage, but obviously something to really pay close attention to, and especially with some of the stuff we talked about today. So we will see you next Thursday at 3. Have a great day, and we'll look forward to seeing you next week.